In accounting, we follow something known as the accounting equation, and you'll see it up here. Assets equals liabilities plus equity. Let's start with assets. What are assets? These are resources that a company owns or controls that are expected to have future benefits. I gave a list here of examples of assets. Cash is an asset, something we own that provides us benefit. Accounts receivable is a new account. This account is when we do something for a customer and the customer owes us the money, meaning we are waiting to receive the money from our customer. And we can abbreviate accounts receivable with AR. Prepaids is another one. We'll just really quick introduce it here. It'll come up again in Chapter 2. Prepaids are items that we pay for, things we pay for in advance of using them. For example, the two most common prepaids are prepaid insurance and prepaid rent. Let's just use the insurance. For example, who here has to buy car insurance? When you purchase car insurance, do you pay it after the time or do you pay it before your coverage begins? Normally we pay for everything before the coverage begins, and that could be coverage for a month, you can pay it for 6 months, or you can pay it even for an entire year. You prepay for those items, hence the term prepaid. Another example of an asset is buildings. Buildings are something that provide us benefit into the future. Land is another example of an asset, as well as equipment. Okay, now this term supplies, I want you to understand that supplies, when we talk about supplies as an asset, these are consumable assets. For example, supplies that would be utilized in a business office would be paper, pencils, ink for the printer, or toner for the printer, or staples, or paper clips. These things get used up. Does that make sense? The next category on the accounting equation are liabilities. Liabilities are creditors' claims on assets. These are the easiest way to remember liabilities is it is stuff we owe. The examples given here are, first one is accounts payable, otherwise known as AP. Accounts payable are when we as a business go and charge something on credit. Think about it on a personal note. You go use a credit card. You go to a store, you buy something, and you swipe your credit card. That is an accounts payable to you, and for the business, it's an accounts payable for us, meaning we have to pay that bill at some point in the future. We owe the money for it. The next item here, this next one, example of a liability, is unearned revenues. Unearned revenues are things, it is money we receive in advance of doing anything for it. For example, who here has ever purchased a magazine subscription, say for a year's worth of magazines, or purchased a newspaper subscription for however long? The deal is you pay for the time up front. And if you look at it from the, let's say, the magazine's point of view, if you look at it from the magazine company's point of view, they have gotten money from you before they did anything for it. So it is referred to as unearned revenues. They haven't done any work for it, so they owe something for the money they received. What they owe you is the magazine or magazines. The last item here under liabilities is a notes payable, otherwise abbreviated NP. Notes payable are longer in duration than an accounts payable. They are monies we owe for a borrowing. Okay, last category on the accounting equation is equity. Equity can also be referred to as our net assets, or the owner's claim on assets, assets minus liabilities. The whole thing is we can manipulate this accounting equation, assets equals liabilities plus equity, to come up with our equity portion. Now, equity is the changes in equity, changes in the overall equity are affected by 4 items, and you'll see the 4 items underneath equity. The first one is the owner's capital, meaning owner's investments. Owner puts money into the business and increases the overall equity of the business. Owner's capital has a positive overall effect on the overall equity. The next item is revenues. These are monies the business makes from selling their product or providing the service, whatever the case may be. So when the business makes money, the overall equity is increased. That's why I have these pluses in front of the 2. The next item that affects overall equity is owner withdrawals. If the owner takes money from the business for personal use or whatever they decide to use it for, the result to the equity is an overall decrease. They have taken something out of the business, decreasing the overall equity. The final item that has an effect or changes our equity is expenses. Expenses are the cost of assets or services used to earn revenues. It's money we spend to make money. For example, we have employees. We have wages that need to be paid. Those are referred to as wages expense. And when we spend money on this, the overall equity is decreasing because we are spending the business money.